we're going to have a correlation spike when all start to move more like each other. I think that move is going to be a down move. I think it's going to be caused by some recognition of earnings not meeting expectations, combined with Fed that is not readily providing imminent accommodation to this market as the economy starts to slow. And with VIX at the lows and correlation at the lows, lots of levered positions, all on the same side, we could have, remember in 2007, we had kind of the Bear Stearns episode first, and that really shook things up in August of 2007. That was more of a market structure kind of weird thing. I think that's what's going to happen now. We're going to have some sort of like market structure sell-off driven by this correlation breakdown, kind of a VIX rally, some structural things, some market dynamic things, some systematic selling, CTA selling. That's going to be your kind of tremor, right? That's going to be your first leg down in selling. Then you'll have a little bit of a bounce back, and then you'll have the more fundamental selling later on as people realize that the economy has slowed, the Fed is late, earnings are struggling, political uncertainty and the like. So it's kind of like we go down, bounce back, then we really go down, and then maybe we have the year-end seasonal rally, then we fall again in January of 2025.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
So I just want to comment because part of that tweet that I put out the other day was stock market peaked in October 2007 while the Fed started to lower rates in September. So they literally cut in September and then the market peaked. 6 months prior to that, New Century Mortgage, the originator, filed for bankruptcy. So that was kind of the canary in the coal mine that you're just kind of equating to Lehman and others. Same idea. But the interesting thing is right now we have earnings expectations again, 17 to 20%, even though they have been literally flat for 6 quarters. The expectations are very high and prices already priced that in of these Mag 7, Mag 10, whatever you want to call it, plus Lilly and Novo for that matter. We have AI being talked down now after, by the way, Sequoia started that whole cycle by investing billions into NVIDIA and others. Now they've made hundreds of billions in the past 2 years, and now they're saying cycle's over. And usually you don't have the bell rung, but literally they're piling on now to get in front of this before price reverses. We also have the election uncertainty, whether it be Biden capable or Trump, oh my, and he's already promised abuse of power. And then, of course, the RFK wild card, which is definitely trending with independents and then some. 4.2% unemployment rate. If we hit it, we get above it. That's the SOM rule that triggers. There will be some immediate reaction in some portfolios just because. And then, of course, if yields do drop below 4.2%, what does that say about economic slowdown and the cuts being pulled forward? It means we do have global demand of credit falling, and that will start to pull forward recession risk and make the whole kind of self-fulfilling prophecy of further growth slowdown. So I think that it's really your key word that kind of triggered me on this was leverage. I think that the reason why this RSP is so a mess, or even your equal weight SPY, both charts, but RSP in particular, is because Oxy doesn't have a double and triple ETF on it like NVIDIA does, or Tesla. Plus the options on the leveraged stock ETFs, the Bitcoin ETF with their leveraged 2 and 3 time ETFs. The point is, that is why I think that the real economy right now is represented in RSP relative to SPY, because this financialization of that leverage, and that's going to be the big unwind. So that brings us all the way back to November 1st, the Fed pause and the Yellen Yahtzee, where all of this took place. And we went hot fire flames higher. So it's one of those deals where if we do hit an air pocket, it would not surprise me one iota that we actually go revisit the November 1st SPX price.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.